Every day, we are learning more about our changing world. Every day, ideas are born, challenges become opportunities. To achieve our purpose, we need people who can turn ideas into reality, who can create success. That's us at ABB. Thinkers, engineers, scientists, innovators. We push the boundaries of technology to make industry safer, more intelligent, and more productive. We address the world's energy challenges with solutions that make transport and infrastructure cleaner. Together with our customers and partners, we are helping to achieve a more sustainable future. Let's write the future together. ABB.
Greetings to you all and a warm welcome to the ABB Capital Markets Day. We would of course have loved to see you in person today, but due to the circumstances, we pushed into the virtual world, but we do hope you will find the afternoon valuable and that it will give you some additional flavor on ABB and where this company is going. Today you will hear from our CEO, Björn Rosengren, and our CFO, Timo Ihamuotila, as well as our business area presidents, but also from two of our divisional presidents who will give you a bit of a more of a deep dive into their respective business. You see the agenda here on the screen. We have in this agenda put in a couple of breaks to give you a proper leg stretcher. It is a virtual event, so we don't want you to pass out behind the screens. We aim to finish the day at about 5 o'clock. For those of you who don't know me, I'm Ann-Sofie Nord, and I will be taken over as Head of Investor Relations after Jess, whom you all know, who will be heading on for new adventures outside of the company. I will try and fill these shoes, and I'm really looking forward to do my best to run this dialogue on the company close with you as investors and analysts, of course together with my colleagues in the IR team. Before I hand you over to Björn and Timo, I would like you, first of all, to remind you that there will be Q&A sessions after each of the presentations. In order to put through a question, you need to dial in using your phone, and there are instructions on how to do so on our webinar site. And also, I would like to put your attention to the important notices, which is on our use of our non-GAAP measures. This covers our forward-looking information that you may hear today, which could contain some uncertainties. And with that said, and without further ado, I will put you over to Björn and Timo. Please go ahead.
Thank you, Ansi. And also I like to welcome you all to this Capital Market Day. Of course, I would have loved to see you all here, but this is not the reality of today. When we met last time in June, Timo and I were presenting the operational structure and the decentralized journey. Today, the focus is going to be on the businesses. It's going to be how our businesses are generating value going forward. I have been here now for approximately 1 year, and I am excited, but I'm also energized of how smooth the transition has gone. And I would like to thank my colleagues who have made this happen. You have heard me say many times, I think ABB has a strong fundamental. We are exposed to markets that are for the future. We are market leaders in the most of the operations where we are and the segments where we are operating. And we have a strong leading technology. So let me elaborate a little bit on this. Many of our customers are focusing more or being more energy efficient. And they do it because of financial reasons, of course, but also that there is a bigger demand from new regulation, but also from you shareholders and other stakeholders who expect to see a more sustainable agenda among their investments. The world is moving towards electrification. And we see the electricity demand is actually growing twice the size than other energy resources. And what you will learn today is that if you look at the world electricity, a third of that is being converted into motion by electric motors. But only 20% of those motors are actually connected to electric speed drives. And that is the enabler for energy efficiency. So besides that the world is moving towards electrification, but also automation and digitalization, the speed of change is accelerating. And I think many of us have realized during this COVID impact that we need to have resilient, flexible, and automated productions. I don't need to tell you, but you all know that the DNA of ABB, it's R&D. It is technical development. And we have been able to introduce game-changing technologies during decades. ABB is investing 2019, 4.7% of its revenues in R&D. And this is actually growing. We are about 7,000 people working with research and development. And about 60% of those are actually focusing on digital and software solutions. We have a huge patent portfolio protecting our intellectual property, 25,000 patents. You know, I love to talk about products. But we will hear a lot about this from our businesses going forward. But I like to highlight one product, which is actually black here on the screen. I don't really know. But that is the Azipod, which is one of the main products within the marine and harbor. And this product actually offers superior value for our customers. The energy efficiency is about 20% lower than mechanical transmissions. And it has strong flexibility for the owner. And we target here special segments like the cruising industry, like the offshore supply vessels, but also ice-breaking vessels. And I'm sure none of you have missed that during the last months, we have actually booked orders for over $400 million for the marine industry. I think this is something to be proud of. As you know, our operating model, the divisions, they are fully accountable for their business. That means everything from R&D to the end user. And as you can see on this picture, is that the amount of investment in R&D in the different divisions varies quite a lot. So on the left side, you can see more of our so-called traditional products. These can be mechanical transmissions, installation products, or simple switches. Even of course, service, traditional service is on that side. As more you move to the right side, more digital, more software embedded in our products. And the division you see furthest to the right, it's actually our discrete automation, B&R, that actually invests more than 10% in R&D. We cooperate in our R&D centers around the world with universities, with startup companies, but also partners in the techno area where they are adding value to our R&D. You know, you have to earn your right by your customers. And I think it's quite impressive with ABB. Almost all of our businesses are market leaders within the segment that we operate. We say that they are number one and number two, and we also expect them to be. And I sometimes get the question, why is it important to be number one or number two? Yeah, number one is market share and profitability goes hand in hand. The other part is, if you are market leader, you have also a chance to be price leader. But maybe the most important of all is if you are market leader, you have the opportunity to invest more in R&D than any of your competition. And then, of course, you have all the scale effects, which are positive. We need to protect our leading position. And our divisions have the mandatory and accountability to drive growth. And we do expect it. I think we all know organic growth is the most profitable way of growing. But we also believe that acquisition, bolt-on acquisition by division, can add value, new technologies, some consolidation of the market, and that is important to protect our leading position. Let it make it clear once and for all. We want to grow all our divisions. We want to grow ABB. But one thing we have learned from before is that there is no idea pushing growth in unstable and unprofitable businesses. That is actually destroying value. No, first you get your house in order, then you focus on growth. If we look at the portfolio, the famous bubble diagram that you know that I love, and we even made it a little bit more transparent for you this time by giving some color to the bubbles. So you almost can guess which bubble is which. But anyway, today about 35 or 37% is today both profitable and stable. These divisions need to focus on growth. And we can see also historically between 16 and 19, they grew with actually as much as 5%. Then we have approximately half of our divisions which are still in the profitability phase, meaning they need to get their act together and get the profitability to the right extent. And then we will focus on growth. But what you also see here, we do not have any divisions that are in crisis. You know, the lowest performance divisions are around 9-10%. And I know that many businesses would wish they would be on that part. But for ABB, who wants to be leading player in these exciting markets, we need to reach the 15%. I hope you agree with me that ABB is well positioned and we have a strong fundament. On the short term in front of us, we see, of course, the challenges with COVID. And it has been a challenging time to be able to serve our customers in a proper way. But we are also convinced that the COVID will not have impact on the long-term trends. So let's look a little bit at the markets. And I picked together a number of PMI scorecards as well as about the industrial production. And what you can see in these scorecards is that during the summer, beginning of summer, end of spring and beginning of summer, we saw a V-shaped recovery. But as you also can see that there are some markets and some segments who have not recovered fully. And some of them are actually flattened out, and we can see some resilience into that. So there are impact of the new close downs in the market. So if you look at this downturn, and I think I'm in the age where I've had quite a numerous of downturns during my careers, but I have not seen anything like this, and I don't think you have either, because it's different. The challenges that we have had this time has been in relation to serving our customer, keeping our operations up and running, and driving service. You know, I'm the biggest fan of service business because that is the resilient business and actually compensate when market gets sour. This time, the service is more affected than our capital equipment. I have never seen it, and it is a big challenge. So when we see the recovery going forward, we will see something like a swash recovery. To be honest, I never heard that word, but they convinced me that you know what that means. Anyway, we will see during the next 3 years a recovery coming of approximately 5% CAGR per year. So there will be opportunities to grow. So let's look back a little bit. The decentralization process started before I came into ABB. And we were moving away from a three-dimensional matrix organization into a decentralized. And we have accelerated that transformation into the structure, the ABB Way, as you see today. And today we have 18 of these divisions with full accountability. But one of the important parts of this transformation has been the dismantling of central resources as well as the country organization. And that has now been taking place during the last 2 years. And we have actually gone from central resources of 18,000 people to just under 1,000. And that's approximately where we should be. If we're looking at some of the reductions, some of the people from the center have, of course, moved into the businesses because that's where we're conducting the value in the future. But some of them have also left. So due to the challenge that we have in the market, we are actually today 10,000 people less than last year. And, you know, Timo has always promised you that we should reach the 500 million in savings. And I got good news. Timo will talk more about it because he's quite excited about it. We are there now. We managed to take down the cost with 500 million. There, of course, is a lot of other activities, continuous improvement in our businesses. And in our operation, we actually have closed 45 sites. 45 sites around the world. And many of these actually comes from the acquisition of GEIS and the integration of that, making a footprint which is competitive. And Tarak will talk more about that later on in the presentation. You know, in the decentralized structure we need some glue to keep the group together. And this summer we introduced both the ABB Purpose, which I will talk about a little bit later, but also the ABB Way. So what is the ABB? It's the glue that holds the group together. And we can actually divide the ABB Way into 4 elements. The first one is our operating business model, but also the way we drive performance management. The second one is related to our people and our culture. The third one is our brand, which actually sits with a lot of value. And the fourth one is the governance. It's actually the procedures, the regulations that all our businesses need to follow. ABB need to add value to our businesses. The businesses need to add value to ABB. So the ABB way, that actually answered the question, how do we operate? The purpose that was also introduced this summer is actually answered the question, why ABB? And this is a project that has been running over a year and has included a lot of personnel, but also stakeholders from outside to define why ABB. And I'm today very happy to present it. It has been really well received internally in the group to understanding why we have the group. So the ABB Way, actually, the purpose actually comes from 5 different themes. 2 is related to our identity. That is creating success. And we know that it always starts with the customer. The other one is leading with technology, which is really the DNA of us. But the next 3 themes, that is actually the impact that we need to do, that we want to do with ABB. And the first one there is actually addressing the world's energy challenge. So what do we mean by that? Yes, the world is growing. More people are moving into the city and want to take part of the good life. But there are challenges when it comes to sustainability and increased energy need. ABB has a tradition of supplying electricity to cities, to houses, to transportation. And we want to do that in a sustainable, in efficient, and a cost-effective way. The second one is transforming industries. We believe that the physical world and the digital world will merge. And we do believe that machines, factories, even cities will be connected, and they will be self-diagnosed and to develop to be more automated and more efficient. And then we have the third one, which is related to the impact we want to do, and that is the sustainability. And sustainability is embedded in everything through the whole value chain within ABB. We'll come back to that a little bit because we have an exciting day where we are introducing our new sustainability targets. So, in a decentralized world, importance is transparency, accountability, and speed. The divisions, they have both the accountability and they need to drive the speed in their decision making to be able to support our customers with their needs. The transparency is the way we follow up the businesses and drive performance management. And I'm really proud of our financial department who have in this short period, we actually introduced the scorecards already in July. And we are working with them now, and I think it's an excellent tool to drive performance going forward. The ownership of the scorecards are the divisions. Based on them, they can take the right decision to develop positively. So, now let's move to another important part of our strategy. It's actually accelerating value creation through digital. And our software and digital strategy can actually be summarized in 3 different points. The first one, in line with our purpose. Our digital strategy is fully focused on creating customer value, superior customer value. The second one is the differentiation comes from our strong domain expertise. And the fourth one is that the expansion within digital is actually led and executed by our divisions. So let me elaborate a little bit on this. So let's start to look at the focus, the strategy going forward, which is related to our offering, but also the way we interact with our customers. When we look at our offering, we look at from three different categories. The first one is our traditional products. These are products that do not have much of embedded software. This can be simple breakers, it can be electric motors, installation products, as I said, or mechanical gear. It can also be traditional service. The second layer is actually software-enabled product. And this area is actually a big part of our business, but also a very fast-growing business. This is products, for instance, it can be drives with embedded software. It can be robots with controls. It can be our DCS, advanced switching gear, and it can be, for instance, PLCs. Then we have the top layer, which is the pure digital. This is software. And here we have products like the robot studios, the design and application software. But we also have new products which have like our industrial analytics, the Genix that was newly introduced into the market. And to connect all the products, it's the ABB platform. And I think you all know that we decided already 2016 to partner with Microsoft to build up our cloud platform. And we have adopted that platform according to ability with a soft layer which makes it very simple to connect our products. You know, the offering towards our customer can be from one of these layers, or it can be a combination to actually generate superior value for our customers. Let's take a look at a little bit what is the differentiation from many of our customers. One is our long relation with our customers. We've been for 100 years operating in different segments with certain industries where we actually build up a domain expertise. So this expertise is actually built on our large installations, our global leadership within the businesses where we operate, and of course, our knowledge and history of that. So the digital drives value, and the digital drives new revenues, but it also improves our margins or our gross margin by adding more software into it. And it also pushes through many of our traditional products. The third point in our strategy is, as you know, our operating model. The divisions and the business areas are driving the expansion within digital. And today we organically invest approximately 5% of our revenues into R&D and digital. And as I said before, 60% of the people in R&D is focusing on this. We are working with strategic partners, not only for the ABB platform, but also for other solutions. And we work with bolt-on acquisitions where we believe going forward. Then to an important part, and I also said that during the last meeting in the summer, focus has been to go through our portfolio review. And we've done it with three different aspects in mind. We have looked at the strategic market attractiveness of the business, which both includes the market as well as the division by itself. We also look at the opportunity to create value going forward. And then, of course, the fit with ABB, which is also related to our purpose. And we have this morning announced that we will exit 3 divisions from ABB. But I do really want to underline, these assets are premium assets. They represent 1.7 billion in sales, that is about 6% of revenues. They have a higher operational margin than the corridor, which is the target for our businesses. But we believe that ABB is not the best owner for these businesses to develop further. We will look when and how, but there is no hurry. But we will look at that. And when it comes to turbocharging, I would like to underline, this is a highly attractive business where we also considering that we might spin it off and put it on the stock market here in Switzerland. So there is one more further regarding the optimization of our structure. You will hear more from Morten later on, but he has made the decision that the motors and generators will be divided into 3 divisions instead of 1. We'll come back to that and talk more about that. We have also decided to change the name of the business here, Industrial Automation, to Process Automation, because we think that better reflects what we are doing within the business area. Okay, I'm going to hand over to Timo, and he will talk a little bit about some other numbers, and I will come back a little bit later. Thank you.
Okay, thank you, Björn, and welcome from my side as well to this first ever virtual ABB Capital Markets Day. Unprecedented times indeed. Today, in the 20 or 25 minutes or so, I will first close the chapter of our major transformation under the ABB operating system, and then focus more from CFO perspective on how we drive improved performance under ABB Way. And let me open with a super important topic, driving quality of revenue. We discussed this at our 2019 Capital Markets Day, and we have made good progress. First, we wanted to target secular growth trends, and we have achieved strong double-digit growth in these targeted high-growth segments. The 6 sectors illustrated here on the side, including, for example, food and beverage and buildings, here they make up now 22% of ABB revenues 2019 compared to 12% 2016. Second, more business on short cycle, more business with distributors. The distributor growth has been about 9% CAGR 16 to 19, and it has been strongest in our motion business. And we will continue to build success together with our distributor partners, for example, creating common e-commerce offerings jointly with them. Third, expanding our digital offering. As Björn said, this will drive new revenue streams, but it will also drive higher gross margin with embedded software and greater pull-through of our traditional offering. We now have over 60% of our R&D employees focused on digital and software innovations, and we will continue to drive our domain expertise-based digital strategy. Last but not least, our exit from high-risk EPC activities has made significant progress. Large orders now make about 5% of group revenues, down from 17% 2015. Now that number, of course, included the power grids as well, and we would expect this 5% to decrease further. Importantly, Mostly of our large projects are now on the 50 million or below category, making project risk more manageable, and they have, as targeted, more than 60% ABB content, which has gone up also during the recent years, the ABB content. And we will continue to drive the better quality of revenue with these four pillars under the ABB Way, and the business leaders will also talk more about this topic. Now, clearly, you need to invest to drive better quality of revenue, and we are focusing our investment behind growth. Under ABB OS, we had this prioritization. If you have extra dollar to invest, it goes to R&D or sales. This mindset continues under the ABB Way. We will steadily grow R&D within our divisions, and within R&D, we prioritize software and digital, and we actually have had double-digit growth on that area on software and digital R&D 19 to 22. Overall, we look to increase our R&D to about 5% of revenue. And let me remind that good R&D is not only new product innovation, it can also drive better quality, better cost performance. And with the right combination of R&D investment in cost, quality, and right product innovation, we think we can drive very good return out of our organic R&D. Then let's look at SG&A on the right side of this picture. I'm actually really quite proud of this achievement, and the whole team is. We have continued to invest in sales, while our G&A is down 5% and 6% 2018, 2019, respectively. And with ABB Way, we will continue diligently this fixed cost prioritization. And this is actually a good segue to my next slide. Björn mentioned the 500 million. Yes, we are proud of this achievement. We have reached it about a year ahead of time, and the final number is actually clearly over 500 million with less than 500 million of implementation cost. About 70% of this comes from G&A, and a bit more than 50% comes from corporate and function. This is actually more than we originally expected. And we are down clearly more than 10,000 people since the beginning of the program. And progress on ABB operating system cost savings has also supported our margins. When we look at, for example, Q3, our revenues were down 4%, margins were up 30 basis points, and we have actually quite a bit of extraordinary items still running through the numbers during that quarter. Let's then look at the corporate cost situation on the right-hand side of this slide. We're making good progress towards our 300 million target from 1.1 billion 2018 to our target of 550 million this year. We confirm the 300 million run rate target for lean corporate, excluding the non-core, and our ambition is to reach this 300 or below from 21, i.e. for full year 2022 latest. And headcount here is an important driver, but I think it's as important, it signifies how large the transformation for us has been. So as Björn mentioned, we started with about 18,000 people in the corporate domain. These people have either moved to business, including PG, left the company, or continued in the corporate. And to be clear, in many cases, our businesses replaced the people who came into the business, so the net number went further down. In our original blueprint, we had 1,300 people to be in the corporate domain. Björn mentioned 1,000, I'll take it further down with 100. So we are expecting to have less than 900 people in the corporate domain with ABB Way. Very important, there is zero overlapping operational activities. For example, R&D or quality operations, zero in corporate. Treasury and tax, zero in businesses. Very clean operating model. Another important topic for us and of course for our investors is the non-core and overall minimizing legacy project impact. And we want to be very transparent here. We are looking to exit these as soon as practicable, but it will still take some time. I'll talk a bit first about the non-core. We have made good progress with a tough portfolio. So we established the non-core business Q4 2017, and now looking at end 2020, we are down from over 200 active projects which we were executing to less than 10. We have taken, or will have taken by the end of this year, operational EBITDA charges of about 700 million, and we have also taken non-operational charges of about 75 million. Now let's look at this going forward. So from 21 onwards, we have two main exposures and then some smaller. We expect max 300 of operational EBITDA impact, and this can happen later than 2021 because there are certain legal proceedings where we simply cannot control the timing, and it is in our interest that we let them run on a, let's call it, probability-weighted risk-return way of thinking. And there can still be some further non-operational charges on non-core. Then on other obligations, these consist mainly of the Kusile project and the steel structures in electrification. These are both coming from time before 2016. In Kusile, we have made a proposed settlement which we think is very fair and also reflected that. Hope we can move there expeditiously forward. Now I want to be clear, as it says in our 20F, the Kusile settlement does not cover the regulatory proceedings outside South Africa, which are currently not estimable. And as ABB, we naturally want to be good corporate citizen everywhere where we operate. We have self-disclosed, self-reported, and we are working in good cooperation with all authorities, and this is naturally there also to minimize the exposure. On steel structures, we target settlement 2021. Let's hope we get there and we would get that sort of off. And then finally, I wanted to touch upon the power grids transaction, because again, there we really want to show that we are transparent. We have said all along during the transaction that there are certain possible obligations, mainly related to projects which were in execution already before signing of the power grids transaction. This is covered by 300 million escrow, which we have represented when we reported the Q3 numbers. Now this list is comprehensive. We continue to work through this, balancing speed and cost for optimal outcome. I know it has been painful. It's still going to be a little bit painful going forward, but let me be very clear, we will not go back to this kind of large scale EPC. We drive the 4 pillars of quality of revenue as we have discussed earlier today. Then let's move from cost to performance management, a bit more from CFO viewpoint. So Björn discussed about the strategic mandates of our divisions and the scorecard system, and I want to be again very clear here. We align the divisional annual incentive plans with the right scorecard KPIs supporting their strategic mandates. So for example, if a division has a profitability improvement mandate, the biggest weight is on EBITDA, then maybe operating free cash flow. On a growth mandate, biggest weight naturally order or revenue growth, but also of EBITDA, because we of course want to keep that margin, that high margin running with the growth, and all have productivity. This is the way we drive continuous improvement going forward under ABB Way. And with this, we make sure that all parts of ABB contribute towards the group targets in the right way. So what will this new performance management system then deliver? As ABB Group, we are prioritizing margin improvement with an ambition to reach the upper half of our midterm 13 to 16 operational EBITDA margin range as from 2023. Part of this uplift is expected to come from market recovery, but as importantly, with ABB Way, we now move from central cost programs to driving systematic continuous improvement. And all business areas and corporate are expected to deliver meaningful continuous improvement, contributing to ABB Group margin expansion. So when we look at the bridge overall, we expect a bit more than half of the margin pickup to come from what one could call self-help, and a bit less from market recovery and other growth initiatives in our businesses. And each of our business areas will today outline their targeted margin improvements. And at the corporate level, of course, we need to bring the corporate cost down to under 300 and exit non-core. That improved margin then, of course, needs to flow into cash. And our cash generation and cash conversion ratios have been impacted by our transformation. 2020 is impacted particularly from transformation and also from our planned pension outsourcing, which we partly completed Q3. Despite this, we are tracking well versus 2018 and 2019, and we continue to expect resilient cash delivery for this year. Now, looking forward, many of our cash drivers will be more favorable. So first, cash flow from operating activities, we expect to see improved margin. We move to very granular net working capital management from percentage of revenue to each of the components. We have scorecards on each of the 3 components. Fewer transformation burdens and one-time charges are clearly expected going forward, and also our effective tax rate is moving from 27 to 25%. At the same time, we would expect our capex to remain approximately at the 750 level. This year, due to COVID partly, it's going to be probably a bit lower than that. And we will also expect lower finance cost driven by capital structure optimization. And importantly, again, very clear responsibilities on cash delivery. Our divisions all have operating free cash flow. It includes restructuring cash out. It includes capex in their targets. And then corporate is fully responsible for tax and finance cost from cash perspective. Björn discussed earlier about ABB portfolio management and the planned exit of the 3 divisions. These are, of course, very important portfolio management decisions, but equally important is that under ABB Way, this systematic portfolio management happens in different levels of our organization. The business areas and divisions are fully responsible for their performance. And under this framework, first of all, we would expect to move to a situation where we have some 5, hopefully 5+ bolt-ons on our divisions. It might take a little bit time to get there. Then similarly, the divisions and business areas use the framework to drive transformation and smaller exit decisions or business improvement decisions. And the business area best presidents will again talk a bit more about this area. And I want to mention this is a real change on how ABB drives both organic and inorganic growth. Let me then cover ABB's adjusted financial framework. So the changes on the framework are kind of like marked on this slide with these little flags. So first, we are redefining our growth framework. We're targeting 3 to 5% annual average growth through the cycle. And we say about 2/3 could be sort of comparable or organic, about 1/3 inorganic. Maybe in the beginning it could be a bit more on the organic side. I'll come back to this on the next slide. On the EBITDA margin, 13 to 16%, upper half as from 2023 onwards. On motion, we are upping the margin from 14 to 18 to 15 to 19. There is no change in the other business areas. There is no change in ROCE, in free cash flow conversion or EPS. However, as I discussed, we expect to move on the effective tax rate from our current 27 level to 25 as from 23 onwards. And for modeling purposes, you can look at that like as a linear decline towards that 25% number. Let's then look at our revised growth target a bit deeper. There are 2 key points I want to note here. First, ABB Group as a whole is still more in the stability and profitability phase than in the growth phase. And when we move firmly to our aspired margin levels, we will naturally focus more and more on driving growth. And second, we think we will deliver better value from our acquisitions when we focus on bolt-on deals driven by our divisions. Importantly, our investors will continue to be able to focus the comparable growth. From the comparable growth, we exclude FX impacts and also transformational acquisitions and divestments, i.e. if we would be selling or buying a whole division, or if the revenue would be more than 5% of the group. And on inorganic growth, we measure bolt-on acquisitions and divestments in our divisions. And we will continue to execute acquisitions under systematic criteria. First of all, the acquisitions naturally need to be synergistic with our core and with our strategy. Or if you look at more like revenue synergy-driven deals, there we want to see higher return than our weighted average cost of capital, latest after year 3. If you look at more like cost synergy-driven deals, there we want to see accretive EPS very latest after 1 year. Let's then talk about our new margin equation. So ABB's new margin equation is very straightforward. Group margin 13 to 16, upper half as from 2023, consists of the business area margins, and the business area margins consist directly of the division margins, i.e. all the business area costs sit with the divisions. And then corporate needs to be 300 or below, and there is no cost allocation from corporate to the business areas nor to the divisions. So this is a super clean model from accountability and speed perspective. There is no place to hide, no place to say, but I got this cost from corporate, so I didn't do this or that. And it really drives transparency, accountability, and speed, as Björn also discussed about. Before I summarize, let me discuss a little bit about ABB's capital allocation priorities. Our capital allocation priorities remain unchanged. First, fund organic growth. Second, pay rising, sustained dividend per share. Third, value-creating acquisitions. And fourth, return additional cash to shareholders. And we expect that our operating cash will well cover funding organic growth and dividends. Our capital structure optimization program is an efficient way to deleverage and improve long-term performance. We can fund planned bolt-on acquisitions within this framework, and our commitment to the 7.6 to 7.8 billion share buyback remains intact. And we continue to target single A credit rating to maintain financial flexibility. So for my final slide today, let me summarize. We have achieved well over 500 million net savings as targeted under ABB Operating System Simplification Program. With ABB Way, we target to clearly improve operational performance by driving our stability and profitability before growth framework, combined with differentiated scorecard KPIs and for incentive plans in different divisions. Overall, as an ABB group, we are still more in the profitability phase than in the growth phase, so our primary midterm target is to drive margin accretion. We continue to evaluate our portfolio in a systematic way at ABB group level, at our business areas, and at our divisions, aim to strengthen our overall business portfolio. As Björn discussed, we want to be number 1 or number 2 in the markets where we participate in, driving better quality of revenues, leading to profitable growth. And finally, our improved cash generation will enhance our flexibility to invest in both organic as well as bolt-on growth, while providing attractive returns to our shareholders. And with that, I want to thank you for the time and hand back over to Björn.
Thank you, Timo, and thank you for the insight. Very, very, very interesting. One of these investors, maybe it was an analyst, who told me that, your margin corridors are pretty boring. And, I have a tendency to agree with that. From my perspective, when I look at the group, 13 to 16 is quite a big difference. I think it's much easier to say, we should be above 15%.
Yeah, and of course 15 is inside 14.5 to 16, so that's very clear.
I hope.
Actually, a little bit lower there.
I hope you agree with me. Now, we're coming into a very important subject for ABB, but not also for me personally. I think the sustainability part of ABB is actually the DNA. ABB has always been a big contributor to sustainability. And I think from that perspective, it is important now to take this extra step to push the boundaries to set up the future. You also saw in our purpose that sustainability is a important part of our achievement, what we want to achieve. So we have now today presented our long-term sustainability targets. That means, where are we going to be here 2030? And we have decided to focus on 3 different pillars. One is to enable a low-carbon society, which I think we all feel very dear for. The other one is, of course, to preserve resources. We know the scarcity. More people on Earth, we are using more of the resources. We need to make sure that we take care of them. And social progress. So if we look at the targets that we set up, let me give you some of these examples. And I think one important part is that ABB operations are going to be carbon neutral 2030. This is a big challenge, I can assure you, in all our operations around the world. That is our target. But if we actually look where we can do the biggest impact when it comes to climate change, it's actually what our products can help our customers to be more efficient. That's where the big impact comes. And we have set the target that year 2030, our customers are going to be able to reduce their emission of CO2 with 100 megaton. You know, when I heard that number before, what is 100 megaton? You know, we throw ourselves with large numbers. But this is actually equivalent with 30 million cars. It is actually equivalent with 40 coal-powered plants. And it is actually equivalent with a small size of a European country. So it really shows what kind of impact ABB can make. The second part is regarding the preserve of resources. And I think circularity needs to be the focus. And we have decided that 2030, 80% of the ABB products and solutions should be covered by our circularity approach. And then when it comes to social progress, we want ABB to be an attractive company to work for. But we also want to be a good citizen where we operate. So we are also pushing the boundaries on this part. So let me summarize a little bit. As I said from the beginning, this day is not about Timo and me. Today, it's about the businesses. Today, we're going to look into how the businesses are going to create value going forward. And I'm quite excited about that. So, by this, I think I want to thank you all for bearing with us and listening to us. And we move over to Q&As, and then we're going to go over to the more exciting part of the day. Thank you very much.
Thank you. And with that, we open up the Q&A sessions. And I already now know that there's quite a few people in the line, so I ask you please to limit yourselves to one question at a time. And we open up with Shane McKenna from Barclays. Please go ahead, Shane.
Yeah, good morning, Björn, Timo, and Ann-Sophie. Hope you're all well, and thank you for taking my question. I should say question rather than question, but I appreciate today's presentation. As in June, I'll see if I can sneak a further one in. You're targeting stability, profitability before growth. But given the cut to organic growth guidance from back in June of 3 to 6%, to today's now 3 to 5%, of which now a third is organic, what has changed since then? Is there a particular division or end market that's driving that reduction over the medium term? Or is this you being much more selective on sort of higher margin revenues? And if I could just sneak one more question in, for IA, because it's not clear in the slides, or should I say process automation, the targeted margin of around 14% in 2023, does that include or exclude the contribution from the turbocharging business? If you could clarify that, that would be great. Sorry for sneaking another in. Thanks.
Sure, let's take the first about growth. And I want to underline the same thing I did in my presentation. We are going to grow all our businesses. But you also see that we are not going to grow businesses that are not really delivering the financial performance. I'll give you an example. I think there are so many companies, underperforming businesses that are acquiring companies with good margin, better performing margin. What happens? Of course, the good performing company actually slides down to the performance of the buyer. It should be the other way around. Exactly like Tarak and his team did with the GIS. You should have a high performing business, then you buy an underperforming business, and then you improve the business. That's how you're going to do it. Yeah, during the beginning of the target period we have forward, we say that, of course, we still have a little bit more than half of our businesses that we need to put a little bit more emphasis of getting the margin in place. While we have about 40% of the business, they're going to go for full speed growth. And I do expect that these businesses today is going to make around 5 to 10 acquisitions per year. That is our target for the business. So I can assure you, we are going to push growth. The reason why we pulled it down a little bit, it's just a realistic. Look a little bit at our history part here. We need to give you guidance where we can make sure that we fulfill the part. And now I think we should do it. We should grow more than 3% per year. That is our objective, and that is what we're going to push. And of course, I would love to grow even more than 5%. So,
should I?
Why don't you take the second one?
Yeah, the second one was on the margins, and clearly out of the three business areas where there would be this possible exit or expected exit. Again, we are not commenting on the timeline of the exit. The biggest proportionate impact would be in IA. We are not moving away from the target, and Peter will talk more about that later today. Even if we would have executed the turbocharger exit, nevertheless, it could require also some inorganic activities on the other side. But I want to comment this from group perspective. If we look at this with or without the portfolio changes, we would expect as a group to be on that or operating on that upper half of our target margin range as of 23 onwards in all scenarios, with or without these three exits.
Thank you.
Very clear. Thanks a lot.
Thank you. And with that, we'll go to the next question, please, and that's Martin Wilkie from Citi. Please, Martin.
Just a question on the cost savings. Obviously, your 500 million cost plan is complete ahead of schedule. In the past, you've had some big corporate-wide plans, the white-collar productivity and so forth. Given there's not been another big announcement of a cost plan today, should we just infer that that is now a divisional responsibility as part of those targets? There's no longer a need for a corporate-wide plan. And then related to that, when you look at the bridge that you've kindly given, Timo, we can see productivity within that. But when we look historically, oftentimes that productivity has been eroded by pricing, by cost inflation, and the retention rates have often been relatively low. How can we think that there's going to be more retention of that productivity in the future than there has been in the past? Thanks.
Okay, thanks Martin, for the questions. So first of all, we are not having another corporate program because the corporate has become super small. So we are still going to go down on that. We are going to reach that 300 million target, but the whole point of the accountability and speed is that this happens in the business. And then this is actually a good segue to your second question. Why will it now happen better than in the future? First of all, in this new model, divisions are fully responsible of all of their cost. And second, as I said in my presentation, and this of course very strongly driven by Björn as well, every single division will have this 3% productivity target in their annual incentives. So let's say you grow 5%, your costs go up 2%, and if you are flat, your costs go down 3%. That's approximately the thinking. We measure productivity with a very simple measure, revenue to headcount, so that we would see the expected impact.
Thank you.
Okay, thank you very much.
Thanks. And now we will hear from Andreas at JP Morgan. Andreas, are you there?
Yeah, good morning. Thanks, everybody, for the time. I have a question on R&D, where you today made some comments about accelerating, particularly on the digital side. Maybe you could elaborate a bit. You said you reviewed the ABB Ability and digital agenda over the last 6 months. What triggered the desire to accelerate that? Has it something to do with kind of the general acceleration in digital during the pandemic? And if you look at your measurement of R&D, the 4.7%, including the digital investments, you talk about 5%. That's a relatively small increase, maybe $75 million or so. What can you really do with that amount of money, given some of the much bigger numbers that others have spent? And how do you specifically going to invest that, and into what areas where you can make a difference?
Yeah, let me talk a little bit about this. I think it's very warm on my heart. As you saw today, that each division is responsible for how much they spend. So we have some, working with traditional, not so much digital, investing much less, while many divisions which have a lot of software embedded digital within them are investing much more. We don't say, from corporate, we are going to invest this much and then it's going to happen. These are the businesses that determine themselves how much do they need to invest to be able to be competitive, come up with new solutions and drive this. And what we have seen during the years that the number of the part of our business, the sales of the portfolio is growing when it comes to pure digital products as well as digital embedded software embedded products. So that is really the most and the fastest growing part of the business. So we are not setting a limit at 5%. That is where we are today. I would not be surprised if this would even be higher next year. The only thing I can assure you will not be lower, because we have our scorecards. We can follow these investments. So if we see any division that is actually cutting on their R&D, we raise a red flag and we are straight on them. That's what the transparency actually is giving. But I do believe that we will continue to drive the digital, and we're going to do it according to the strategy that we have presented. And we feel pretty comfortable about that. So, it's, the revenues went down. Your number, 4.7 and 5. The revenues, of course, have gone down because of the pandemic. So, of course, the margins have gone up a little bit. But we should be around 5%, I feel is the right number. And, of course, 60% of the engineers, the researchers, are actually today working with software application and embedded software.
There was a question also on, if I comment just on where is this targeted. So, for example, I think in the robotics will be an area where we would expect R&D to go up. Absolutely. Just to give an example.
Yes, thank you. And we take the next question, please, and that's from Mattias Holmberg at DNB.
Thank you. You've already touched on the sales growth target, so sorry for dwelling on this, but if I look at the swoosh recovery scenario that you refer to, Björn, which implies a 5% market CAGR until 2023, how should we think of that you're only targeting 2 to 3 or say 3.5% organic growth? You're backing out the 2/3 from the overall growth target. Am I understanding it right that you're expecting organic growth to be below the 5% you see for the market? And if that is the case, can you help us understanding a bit where this discrepancy is coming from, please?
I think these 5% that I said during next 3, that is not ABB. That is actually the market that we see will recover in this part. Our ambition is, according to our growth targets, is to be above 3%, between 3 and 5%. And that is our targets year after year. We will, of course, if the market gives the opportunity, we will, of course, grow faster. And, of course, some of our businesses who have been hardest hit by the COVID will, of course, also bounce back a little bit faster. So some of the numbers might look a little bit higher during next year.
Yeah, if I comment on that as well, I mean, we said that this is through cycle. Now we are in a very unusual year, of course, here sitting at 2020, so it does not exclude at all a scenario that we would grow with the market. It's difficult to know where the market exactly goes now next year and so forth, and then we'll see it to recover. So we are not by this saying that we expect to grow slower than the market. Again, this is through cycle. I think the most important is that in a normal scenario, we have realistic targets which we can meet and beat and move forward with that.
That's clear. Thank you.
Thank you, Matthias. And now we move to Daniela Costa from Goldman Sachs. Daniela, please go ahead.
Hi, good morning. Hope you can hear me well and everyone's all right. I have 2 questions. One question I wanted to follow up on. You talked a lot throughout the presentation about the focus on digital and software, R&D increases and all of that. I'm just interested to understand sort of why did you decide to go the organic way here versus, for example, some of your peers which decided to do like a one big step into getting into software and then accelerate growth from there. Just curious on that decision. And then one question for Timo, just a quick question on the tax rate, the 2 percentage points improvement. Where exactly does this come from? I guess you're talking about it as sustainable going forward, but you mostly have done around 27 or higher in the past. So is actually a meaningful impact interested in the context? Thank you very much.
Yeah, thanks, Daniela. Why don't I take the questions here? So if you look at these large software acquisitions, as we said, we execute our domain-based digital strategy. There are companies out there which have bought software businesses, and then the question is, will these software businesses they have bought somehow significantly improve their market position in the product businesses which drive embedded software and of course in the traditional product business? Our view of that is that it is not the case. We don't know, of course, how this works forward. We are comfortable with our strategy, and we think that when we look at bolt-on acquisitions, they bring best return when we invest within our divisions. And there, of course, we are interested in buying technologies. We're okay to pay high multiple on businesses which support and make our current businesses even better. This is different than buying a software business and deciding we are now in software business. So that's how we look at that. And of course, Björn, if you want to add. And then on the tax rate, so this is a change partly driven by the fact that we have now fully executed the PG carve-out. Our geographic situation is a little bit different, and we have now had a bit more time to focus also on this responsibility split, as I said, operating free cash flow, fully divisions and business areas, tax, fully corporate. Now when we have this new framework, we have looked into it after Power Grid's exit, and we see that we have good path to get to this 25% 2023 and then a target to stay on that level. Of course, that assumes that nothing crazy happens in the global tax environment, which would totally change the picture.
Thank you. And now we open up the line for Alistair Leslie from SocGen. Are you there, Alistair?
Yeah, hi. Good afternoon, thank you. Just a question on the bolt-on M&A comments that you just made. I was just wondering whether the business is going for growth, kind of ready to make the kind of, I think you said 5 to 10 smaller acquisitions a year. Björn, I think your successor at Sandvik effectively said recently he needed to push the divisions to be more proactive around M&A and change the mindset there to take on a little bit more risk. So I was just wondering if you sort of see some of the challenges at ABB, given the kind of the move from a centralized structure to a decentralized structure is kind of in its infancy. Thank you.
Thank you. I think it's a very motivated question. I think traditionally we know that all these acquisitions have been driven centrally, and the businesses have not really been so much involved in them. This is of course changed now, and the ownership of the business is actually out there, which means that the divisions can acquire businesses. They can consolidate the market, or they can buy technology to add on to it. The important thing is that the business keeps its leading position and continue to grow and delivers value. That is the important. Do we have that now in the businesses? I think the business have started now to focus, with help of banks and other one who will, find good, attractive targets, but also through our domain expertise that we have in the different businesses, what could. So we are putting in a lot of pressure on that part, and I think that growth will come through acquisitions. That's my experience. It takes maybe a little bit time to get. You need to be two to tango, and you have to find the right price to drive it. But yes, we will have a focus. Not only us in the executive committee, but also the board is very interested to see what kind of add-on acquisition that is going to be. I said that I think a company like ABB should have between 5 to 10 acquisition problem. And of course, we say that when you are stable and profitable, you go for growth. And that's also where you start focusing on that. Then you also talk about consolidating businesses in the market. While you might not really be there on performance, and if their business is stable, and you really need some technology add-on, because that's crucial for the future, the division is also allowed to make that acquisition. So I just want to underline that.
Purely maybe from technical perspective, of course, this pipeline development in each of the business areas is again part of the portfolio management strategy.
Thank you.
Great, thank you. Thank you very much, guys.
Thank you. Guillermo from UBS, please, your line is open, I hope.
Yes, thank you very much, Guillermo here. Good morning or good afternoon, Nancy, Timo, and Björn. I wanted to ask one question on portfolio management. When looking at, for example, industrial automation, and when identifying some of your positions that are basically low on the market in terms of market share or positioning in the market, you also find potentially low growth prospects as well. Basically referring to OGC, in which you have a 3 to 5 market position, and you can say a relatively lackluster growth, outlook as we go forward. And similarly on instrumentation, which is, again, it could be impacted to some extent by low growth and also a 3 to 5 market position. So I wonder whether, why actually on portfolio optimization or portfolio management these divisions remain at ABB, or what's the in a way the message for these divisions going forward? Thank you.
Well, if Guillermo, Timo here, why don't I start this? I would actually say that this question should be best answered by Peter when he comes and talks about the business. So we have announced now today what we are planning to do on the overall portfolio on divisional level. And of course, we are not going to announce anything more, and I think it's important that we go through the business area presentations and see how our business area presidents look at their portfolios and how they are making better performance with these portfolios and what their thinking is on there. So at least I'm not sort of here.
I think also important here that this is not a one-time shot. We continuously challenge the business areas and divisions, if they are core for our business. And we'll continue to do that. We'll see now which businesses are actually developing according to the plan. If we see businesses is not really living up to the quality standard of ABB, we might take different decisions. So now we set this up, and we will be shooting hard, and we'll be reaching our targets going forward, and we'll see what happens further on. I hope it answers some. Yeah.
So Guillermo, you tuned in for a question later on with Peter. I can see he's already started preparing. We're moving to Alex, please, of Bank of America. Are you there, Alex?
Yes, I am indeed. Thanks very much, Antti. Good morning, good afternoon to you all. So I guess I'm going to ask a slightly impertinent question, I'm afraid. You mentioned the 13 to 16% range was called boring. You said a number of times, June and today as well, that you believe we should be talking about 15% plus for the group. So why not make that an explicit target? Is this just a point about being able to develop consistent track record on expectations, etc.? But just wondered if you could maybe address that. Thank you.
Yeah, I know. We could of course have done that, but I think we were pretty comfortable with the targets. We made some adjustments. We're going to let the businesses work themselves into that. What I've been talking about is 15%, and that is in my heart, and I will, in the end, make sure that we will get there as a group. But I think we had these financial targets which have been worked out very seriously during a period. We have made some adjustments to these parts, and I think we are pretty comfortable with the levels here. But you know me, and of course you can hit on me if we wouldn't reach it. So, but from my perspective, that's where a group like ABB should be, and I hope you agree with me.
Thank you.
Thank you, Alex. We move on to Joe Giordano from Cowen and Co. Please, Joe, go ahead.
Hi, thank you. On the 3 to 5% growth, do you guys feel that at this point you're more equipped to maybe outperform when the market's weak and not decline as much, but maybe challenge to outgrow in the peak of the market? And then I know we'll get to second question in robotics when you do the presentation there, but for markets like that where there's a robust private market but things are changing rapidly and markets like logistics are expanding very quickly, like how well equipped do you think you guys are to move quickly in a market like that? Thank you.
Yeah, let's first take the robotics side part. I think you will have an excellent, because these are the subjects that will be actually covered by Sami today. So I think we wait and let he and his team do answer the one. When I come on the growth side, we're going to outperform the market, and so I think we'll need first to see where the market is coming back now after COVID, and to make sure that we get the market to the 5% CAGR where we have shown today. Of course, no one knows really about the future, but that is, we will make sure we push growth in some of the divisions, and we will always try to outperform the market.
Yeah, and this question of course also depends how the mix develops, so how different subsegments of the market developed. We have by no means plan to lose share anywhere where we want to operate. So clearly the question is then, how do you define the market and how will the mix in that market change? And of course, there again, we have a systematic way with the better quality of revenue thinking to drive our offering and our channel towards better secular growth markets. We will continue to drive with that. It is really a long-term thinking, and with that, of course, gradually we will ramp up into a better market growth. I think what was said earlier today already many times, this target, you should see it as a target which is an annual target through cycle. And of course, it takes into account that as ABB Group now we are more on the profitability phase. Björn went also through these numbers, then in a growth phase. When we move towards more to the growth, of course, we'll start to then think about this and push this differently.
Yeah.
Thank you. And with that, we're sort of coming towards the end of this Q&A session. So we take the final question from Ben at Morgan Stanley. Please go ahead, Ben.
Good morning, and thank you for taking the question. And I appreciate that there's already been quite a lot on this, but Björn, I wanted to understand your kind of thinking about this pure software layer. I get the difference between the embedded software and the pure software, but at the moment, if we think about Robot Studio, data analytics, ABB Ability, the things you mentioned, that's still a relatively small sort of revenue stream within ABB. Is it pure software that you actually want to emphasize and grow, or is it sort of digital overall? Can you give us your sense of, I appreciate you're not going to do acquisitions, but how do you build out subscription or license or differentiated revenue from software? Thank you.
First, I think, thank you for the question, Ben. I think going forward, yes, we, of course, even like to sell pure software, as we said. We talk about a number of different parts. We have just newly launched this industrial analytics, Genix, which is one that we are pushing out. So we have been developing. But what we have said, of course, that they need to be within the domain, and it's about lifting the value creation for the customers. So we are not, put it this way, we are not going to buy a big software company just to have a bigger percentage of our revenues to be software. But we, of course, in both the embedded as well as software within the different business will grow all the time in the future because the products have more software, they are more connected products, and there are more pure software products that we are being put into it. And we are absolutely open, as Timo said, to buy software companies, but they have to be synergetic. That is important. They must add something. They can add to some products. They add value to a drive, or they can help us to do predictive maintenance or whatever we need to develop. That's the type of software. So we are not just buying a vertical software company that says, now we are a soft company. We do not believe for ABB that is the route to go. You want to add something there, Timo?
No, I think it's comprehensive.
Yeah, thank you.
And with that...
Understood, thank you.
Very good, Ben. And with that, we close this Q&A session. We now give you a little bit of a breather, time for you to stretch your legs, and we'll see you back here in 30 minutes. See you then. Thank you.